This is the start, Tony, of a 4-part series that we are doing every Monday for the next 4 weeks. So for the next 4 weeks, we are doing something called an earnings season playbook. With earnings season around the corner, today we're going to drive into the key metrics needed to navigate these trades. Earnings trades can present unique opportunities, but it's crucial to understand the factors that impact outcomes. Earnings trades, by the way, have, in my opinion, one of the smallest amounts of edge that you're going to get. They're interesting because they're binary. They're interesting because they're immediate. They're interesting because it's almost like instant gratification if you're right. But the other side to that is there is very little edge. Even if you're working with a smaller account, earnings trades can still be a viable strategy when risk is carefully managed. By focusing on proper risk management, you can position yourself to capitalize on market moves while minimizing potential downsides. Hey, one thing I think that's interesting about earnings trades, I just looked at Netflix. Yep. Man, not much trading in there.
Not a lot of trading. The markets aren't as tight as I would thought too, to be honest with you.
Yeah, I did a Netflix trade. I tried to sell calls in there this morning because I was a little bearish.
It is a $700 stock.
I understand that. I sold the November 870 calls, tried to. Took me forever to get them off. So there's not a lot there, dude. So when traded mechanically, a few of the many advantages of earnings trades, and these are the advantages, most trade with high IV or high IVR. They provide an opportunity for lots of occurrences in stocks you might not normally trade. I think before we just go on here, I also need to point out that they also have a downside. And the downside is you have very little time to adjust. Usually your bet is made for you. Choosing the right duration is never easy because they're all mathematically accurate. A, you don't have time to adjust, and B, the outlier moves are hard to make back, right?
That's fair. That's fair.
That's the downside. So stocks exhibiting high implied volatility above 30 tend to experience earnings-related changes in implied volatility exceeding 30% more often than typical trading days. So what we're looking at here is, which I think is interesting, since we looked at 6 years worth of data, and we basically said, if you looked at Apple, Microsoft, Netflix, Amazon, and you looked at the average number, notional IV, the average, you would see that it's about 35. When you look at it around earnings, it's about 42. The difference there on a percentage basis is about 20%. So if you're looking to know kind of like, what are we talking about with heightened volatility? It doesn't matter whether it's Apple, Microsoft, Netflix, Amazon. On average, throw them all together, it's about 20% higher, right? 35 to 42 is 20%.
Yep.
The standard deviation of implied volatility around earnings, okay, this is the big number. It's essentially, we're talking about plus or minus 8% in Apple, 8% in Microsoft, 14% in Netflix. Remember that because that's tomorrow, 10% in Amazon. And the reason I say remember this because it's tomorrow is Netflix has the highest standard deviation IV change around earnings. And when it does because for a reason. It's the most risky. Sure. So when you look at Apple, Microsoft, Netflix, and Amazon, the riskiest of those 4 stocks is Netflix. That's why it has the biggest range of implied volatility. But the average number is 10.3. These are all really interesting numbers. Statistically, we can create earnings with similar pop and a win percentage as a standard 45-day to expiration strangle. Since 2018, we sold 16 Delta Strangles, 45 days to expiration, and then we sold 16 Delta Strangles closest to earnings and held for a day in those same 4 stocks. This is kind of really cool research. And so we looked at 6 years worth of research. And if you look at the win rate overall, selling 16 Delta Strangles, it's 72%, which is a little bit less than it would be for the indexes. But, there's more potential profit here. Actually, Apple and Netflix dragged it down a little bit at theoretical, and Microsoft and Amazon were higher than that. But what's interesting here is the win rate only on earnings was virtually the same. If you look and see which one is the worst of all these in the last 6 years, it's Netflix.
So the numbers don't lie, really, is what you're looking at here.
The numbers don't lie, but Netflix has been hard to grind out.
Sure,
Netflix has actually underperformed theoretical.
So you think more will this change your opinion on maybe more of a directional bias in Netflix?
It's not going to change. It does a little bit more of a directional bias in Netflix. I'm inclined to be short in Netflix just because the stock's so high. But I guess my argument here is that if you were going to choose to sit one out because of low volume or low liquidity, Netflix would probably be the one you sit out. Let's go next slide.
Understood.
We trade earnings small.
And Netflix earnings are Thursday, not tomorrow. I think you said tomorrow.
Oh, I thought it was tomorrow. It's not tomorrow?
It's the 17th after the close.
Oh, sorry, that's Thursday. Then something had earnings tomorrow. I don't remember what it is. Okay, not a big deal.
Yep.
So the next thing we did is we looked at average price movement, the same 4 stocks. When you look at the change, they switched the order here, but when you look at the change around earnings, it's plus or minus 7.2%. When you look at the change without earnings, it's 2.4. When you're thinking about just your earnings risk and earnings volatility, it's almost 3x exactly.
That's pretty cool.
Oh, these are good numbers.
Mm-hmm. Yeah, good numbers.
Here's how the key mechanics differ from 45-day trades. First is timing. Place your trade the day before earnings announcement to capture the pre-earnings volatility. Now, when they say the day before, you could do it 2 days before, you could do it the day before, you could do it the day of. Really matter? There's nobody knows for sure when you're going to sell the high tick in volatility. Each stock is very different.
Nobody knows for sure. Are you confident about that?
I happen to be very confident.
Fair enough.
Keep your size small to ensure that risk is consistent. That's 100%. Ideally, exit your position the morning after earnings. I mean, that's up to you. Tony and I like to lock in profits or adjust trades the morning after earnings. And use option strategies that benefit from high implied volatility pre-announcement, and avoid concentrating too much risk in one earnings play to protect against unexpected outcomes. I mean, that's common